Like fish and chips or salt and pepper, insurance goes hand in hand with interest rates. Low rates, so the theory goes, make it much harder for insurers to make profits. The amount that they can earn on their investment falls, whilst it's also harder for them to meet promises that they've made to their customers. Aviva's share price might seem to bear this out. 16 years ago, when interest rates were above 6%, Aviva's shares were trading over £10. Now, with interest rates at 0.25%, they're about half that level. I asked Mark Wilson, who's been chief executive for about 4 years, how he's tried to break that link between interest rates and insurance.
If you have a look, most international investors think there's this link. If you're an insurance company, you must be sensitive to interest rates. But that's like suggesting that all cars behave the same way in wet weather. It just isn't the case. And it so happens that Aviva performs very well in wet weather. And there's a few reasons for this. Firstly, just the fact, as our product range, we don't have a lot of guarantees. Secondly, our balance sheet. We've gone from having probably one of the weaker balance sheets in the market to one of the strongest. And we've built it so it's resilient. Think of it like we fixed the roof while the sun was shining. And now there's a few storm clouds around. We've got a pretty good roof.
One of the things about low interest rates is that it makes it difficult for investors of all kinds to make a good return on their investments. How is Aviva managing to find good investments at the moment?
Well, we're pretty well matched with our back book, and that helps. But we are interested in infrastructure. Over the next couple of years, we'd expect to put at least another £10 billion into infrastructure. But the government and the regulators need to play ball here. Europe and the UK needs infrastructure, and the regulations are fighting against us doing it. I'll give you an example. If I was to invest 100 million in, say, a green wind farm, and if I was based in Canada, I'd have to put an extra 3 million in capital against it. If I do the same investment here in the UK or Europe, I'd have to put an extra 10 to 12 million of capital against it. That's at least 3 times more capital. Well, that makes no sense. Industry, government, regulators need to get together, and we need to sort it out.
So do the Solvency II rules need to change?
Yeah, Solvency II is a key part of it. And Solvency II actually penalises long-term investment like infrastructure. And I don't think that's acceptable, and I don't think that's sustainable.
The UK, where Aviva generates about half its profits, is forecast to grow at about 2% annually over the next few years. But Mr. Wilson wants Aviva to grow at twice that rate. Can he really pull it off?
Mid-single-digit growth is actually what we're saying. And we're pretty comfortable we can get that. If you have a look at our various businesses and break them down in their component parts. So the businesses in the UK, for example, the asset management business is growing very strongly, strong double-digit growth. Things like auto-enrolment is predicted to triple in the next 10 years, and we're the biggest provider of pensions in the UK. So you can see some tailwinds for growth. Also remember, well over 40% of our business is offshore. Obviously, we're getting a bit of exchange rate helps with the weaker sterling. That's helping our earnings a bit as well. So there's plenty of avenues for growth across it. What about Canada, Poland, and Turkey? And in each of those markets, we're in a number 2 position. We're growing strong, and you'd expect that to continue.
There are a lot of opportunities in the retirement market, but some of your competitors have pulled back, saying that they can't make money in retirement at the moment. How can you make money there?
Well, it's about having all the levers to pull. So some products aren't going to be as popular with low interest rates. Things like individual annuities. Conversely, bulk annuities might be better because people have to fill the pension fund deficits that we have here in the UK. But we see retirement income generally as a key thing. If you have a look in the UK though, the UK savings rates at the moment are 3.8%. That is a 50-year low. We clearly have a savings gap in the UK, and companies like us are going to fill some of that gap. The question is, what will the government policy be going forward?
Ahead of the Brexit vote, Mr. Wilson was a vocal Remain supporter, and indeed, immediately after the referendum, Aviva's share price fell sharply. But the company said there will be no significant impact on its operations, and indeed its share price has since recovered. But can such a big company really remain unaffected by such a significant event?
If you look at Aviva specifically, we've been consistent on this. We really don't have any operational impact. The reason is because we have subsidiaries in all our countries, so it's no easier for me doing business in, I don't know, France than it is in Singapore. In fact, it's harder. So there's no operational impact. The only difference might be Ireland, where we have a branch and we'll have to do something structurally there, but we're working through that now. What about Brexit? Well, as you know, I thought we should stay in because I thought there'd be an economic impact. So far, there hasn't. There's still some degree of uncertainty around, but the fact that the government's taking a strong position, we're moving forward, businesses crave certainty. I still think we have clearly a couple of years of a lot of uncertainty, and I think we'll work through it. So whenever you go through a period of change, there's also opportunity as well as threat. And as a company, each company is going to be performed differently under Brexit, and we're pretty well positioned.